Hi dear traders! This week the spotlight will be on the key event of the month, the monetary policy meeting of the US Federal Reserve. The intrigue is not about potential rate changes, it's widely believed that rates will remain the same. Traders will be watching for the Federal Reserve's plans concerning future rate hikes, as speculations on this topic are shaping investors' sentiments and dictating the direction of price movements. The US dollar index, which demonstrates its performance against the basket of 6 major currencies, has settled firmly near the 6-month high above the level of 105. Last week's macroeconomic data from the US only bolstered investors' optimism. Many now believe that the Federal Reserve can achieve a soft landing even with high interest rates. Retail sales data outperformed analysts' expectations. Notably, this is a crucial indicator as consumer spending accounts for about 2/3 of the entire US GDP volume. The US dollar also gained strength against the euro after what many believe was the European Central Bank's final rate hike in this current cycle of monetary policy tightening. This sentiment was especially strengthened after comments by ECB President Christine Lagarde, who actually confirmed this assumption. Despite high inflation rates, it appears that monetary authorities are choosing to support the economy rather than follow the US aggressive model of inflation fighting. The ECB recognizes that the Fed's approach is not a perfect fit for the Eurozone. The British pound has depreciated against the greenback, sliding to its lowest level in the last 4 months. The UK's weak macroeconomic performance compared to the US, coupled with a decrease in credit demand and economic slowdown, has forced the Bank of England to hit a pause in its fight against high inflation. However, forecasts suggest that the upcoming meeting of the UK regulator might result in a 25 basis point rate hike, given the bank's traditionally conservative approach. Still, such forecasts are not bolstering the pound, as the British pound-American dollar pair roped up the past trading week at 1.2380. The US dollar also gained ground against the Japanese yen of the past week. The dollar-yen pair is once again testing the 148 mark and also the patience of the Japanese monetary authorities. For now, government officials have limited their interventions to verbal statements. The governor of the Bank of Japan has openly declared intentions to end the era of negative interest rates, but only when inflation slows to a 2% level. Given the movement of the dollar-yen pair, investors seem skeptical of this happening anytime soon. Gold has reacted to the improved risk appetite among market participants. Finally, the flow of macroeconomic data from China is beginning to signal the start of a recovery process. The world's second largest economy is reviving, although at a slower pace. Traders' activity on gold has been relatively muted. Gold closed the previous trading week on a positive note, moving towards the key level of $1,930 per troy ounce. Oil traders, on the other hand, have displayed a starkly different sentiment. The price of gold is steadily moving upwards, and by the close of trading of Friday, it settled around $94 per barrel for Brent crude. This marks the third consecutive week of growth. Oil traders are confident that China will soon increase its energy consumption alongside accelerated economic growth rates. Encouraging signs suggest that many central banks might prioritize economic growth over fighting inflation, thus halting rate hikes. Clearly, the demand for oil will continue to rise. What's more, the agreement between Russia and Saudi Arabia to voluntarily reduce oil output will definitely continue to push prices higher. These are the trends of the last trading week. Do not miss our daily news reports to be always in touch with the latest events. See you!